Newfound Gold has discovered what some are billing as potentially Canada's most significant discovery in the last decade. Hole NFGC01 revealed 19 meters at 93 grams per ton, starting at only 96 meters downhole. With over 70 million in working capital, Newfound Gold is well positioned for what the future brings. To learn more, find us online at newfoundgold.ca.
Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today on the program is returning guest Mark Yusko. He's the CEO of Morgan Creek Capital. Real Vision has termed him an investing rock star. How are you today, Mark?
Doing well, and Raul and co are far too kind, but I'll take it since I did grow up in the 70s, so I do like rock music.
Well, it's great to have you back, and I like one of your tweets, and it's the perfect reason that we like having you on the show is because in a world with too much info, synthesis equals your edge, and I think you do a great job of really providing a great synthesis and fitting pieces of the puzzle together. So why don't we start by talking about how interest rates are so low relative to bonds, and that kind of points us to the conclusion that everybody should own stocks. So why is that not necessarily true right now? And maybe let's go through a couple of other indicators that are pointing in the wrong direction.
Yeah, look, it's such a great point. There's even an acronym for it, TINA, there is no alternative. And, everybody's used this Fed model for a while, which basically, takes the inverse of the earnings yield and turns it into a PE ratio equivalent. And the problem with it is the math breaks down. I have this hashtag math is hard, right? And math is hard for most people. And higher level math is really hard, and exponential math is really, really hard. And the challenge here is if you just think about it logically. So as interest rates fall, theoretically, you're discounting your future stream of cash flows at a lower number. So if you're dividing by a lower number, you're getting a bigger product. And so at the end of the day, let's take it to its extreme craziness. If interest rates are zero, are stocks worth infinity? I mean, that just doesn't make any sense, right? Anything divided by zero is infinity. Well, how about if they're negative? What do we do then? Which they are in Europe and Japan and all over the place. So basically below 2%, this whole idea of the Fed model is bogus, yet people still talk about it, and yet they don't look in the mirror and say, how about this year? If we look at long bonds relative to stocks, long bonds are winning. Long bonds are up about 24%, stocks are basically flat. How about over the last 2 years? Long bonds up almost 40%, stocks up about 10%. Well, wait a minute, what about 20 years? Yep, long bonds win again. So this idea that stocks always beat bonds, first, is crazy. It's all about valuation and starting points. And everybody says, but interest rates are so low, they have to be a bad bet. Well, think about it. When governments get into the situation where they are now, where they become despotic or cronyist, and all the power is at this very small number of people at the top, what do they tend toward, right? Think of empires, Roman Empire, Ottoman Empire, Persian Empire. Empires fall. Why do they fall? Because the despots, the emperors, they put too much debt on the books. They spend too much lavishly on cronyist projects. And when you have too much debt, I would talk about this as the killer Ds, right? When you have bad demographics, so aging demographics, so older people, so they're less productive, they don't earn as much, they don't spend as much, so your economy starts to slow. Then you have excess debt, that becomes deflationary because when you have too much debt, what are the four things you can do with it? Well, one, you can pay it back. Governments around the world cannot pay their debt back. They don't have enough revenue. They have bad demographics. Their tax receipts are declining. Growth is declining. Global trade is declining. It's ugly. So there's no way they can pay it back. You could try to restructure it. Problem is the owners don't want to restructure. They actually want to get paid. So you could default on it. Third option, well, you can't do that because then if you're in power, you get kicked out of power. So that's not happening. So what do? Well, you inflate it away. You devalue your currency. You debauch your currency. And that's what's happened in history, every currency in the world, right? The Roman solidus used to be the most powerful coin in the world. If you had a solidus, you were solid. That's where the word comes from. You were a citizen. Today it's worthless, right? And every currency follows that path. And that's kind of where we are today. And so this idea that low interest rates are a sign of economic strength is ludicrous. Low interest rates are a sign of economic weakness. And I have a forward-looking forecast, which is that every interest rate in the world, probably sooner than we think, is going to be negative. Not only zero, but negative. And so bonds probably going to beat stocks for a while. That's kind of a crazy thought.
One of your other pieces of information that I found really interesting doing some prep for this interview is 38% of the S&P 1500 can't service their debt. So that points exactly towards interest rates not being able to ever climb from this point.
Oh, yeah. I mean, hashtag zombie markets, right? We have so many zombie companies. And look, governments have too much debt. Corporations have too much debt. We have the highest debt levels in corporate history. There's so many companies that not only can they not pay back their debt, they can't even service their debt, the point you just made, right? Here's the crazy thing, right? There are three types of finance. There's hedged finance, where I lend you money with the expectation that you'll pay me back both principal and interest. Then there's speculative finance, where I loan you money knowing you could never pay me back the principal, but I think you can make the interest payments. Then there's Ponzi finance, where I lend you money and I know you can't pay me the principal back, and I know you can't even pay me the interest, so I give you zero interest, bullet loan, because I think you're going to flip the asset and give me my money back that way. So that's where we are today. We are in Ponzi finance, and Ponzi is a bad word when it comes to finance. We know how it ends. It ends badly. And so corporations have a huge problem, right? The equity of many corporations is pretty much worthless, right? They have too much debt. The bond owners are going to be the new equity owners. But we're in this environment where central banks globally keep buying up riskier and riskier assets to keep the Ponzi going. And if you think about it, it's gotten to an extreme, not just in the bond market, but in the stock market, right? We put trillions with a T, and just to remind listeners, 1 trillion, forget 10, 15, 20 trillion, but 1 trillion is if you and I sat here on the phone and for the next 31,710 years, which might be actually unpleasant, and we spent $1 every second, that's $1 trillion. So that amount of capital can just never be paid back. And it's, I said, governments, corporations, individuals. And because of that, we've poured all this stimulus money into markets, and it's basically gone to 7 stocks, the Fangman stocks. And so we've inflated the value of a small number of companies. The rest of the companies, really, their equity has no inherent value. And ultimately, we're going to have this cataclysmic reset. Don't know when, right? A good economist says what or when, never together. I'm actually not an economist. So I don't know when, but I definitely know what. And the what is there will be a restructuring, just like there was in the 1800s, just like there was in 1929, just like there was in 1974, just like there was in 2000, 2009. There will be another one. And this one's going to be the biggest one yet, which is kind of crazy.
So Mark, let's talk a little bit about 3 of the 4 horsemen, as you call it, pointing towards a quote unquote recovery right now: copper, treasuries, oil, and Korean stocks.
Yeah, look, I call it the 4 horsemen of the growth apocalypse. And, global trade is collapsing, global growth is collapsing. And there are these 4 indicators that you watch to tell you whether you're in an expansion or a contraction. One is Dr. Copper, so the amount of copper used usually is a signal of economic growth or decline. The second is 10-year interest rates. Third is the price of oil. And the fourth is KOSPI, the Korean Stock Exchange, because so many of the listed companies there are the components companies that go into technology companies around the world. And so the interesting thing, and I've been talking about this on my weekly podcast, but my weekly webinars, is there's this interesting dilemma for us that believe we're in a non-recovery mode in a decline scenario, which is copper has sprung to life since March 23rd. It's broken out of quarantine. It's broken out of sick bay. It's feeling good. Now, I will argue that that is pure speculation because other commodity prices have done well and they were just, so cheap and governments printed so much money. And one thing that, with pro sports shut down and Vegas shut down, people are going to gamble. So what are they gambling on? They're gambling on commodities and stocks. And in fact, in China, they're actually encouraging gambling by extending very low interest margin loans to day traders. So I think that's what's happening in the copper markets. Oil prices are interesting. Oil prices look like they're rising, but they're still below where they were in January, February. But remember, they went negative for a few weeks in April. And so we've had this big bounce off the bottom. I mean, I love this, right? Saudi Arabia and Russia announced that they're going to flood the market with oil. They crash prices. Then their big sovereign wealth funds go out and buy huge stakes in oil companies and cruise lines. And then they say, oh, nope, just kidding. We're not going to flood the market with oil. We'll take it back. And oil prices recover and they make a killing. So that's blatant market manipulation. I guess it's not illegal, technically. It's not insider trading, but it is manipulation. So oil prices don't look that attractive to me, and the supply-demand imbalance looks kind of weak. But it is rising. And then Kospi loves QE. And Korean stocks have been going straight up. And that's just flows, right? People are putting money into emerging markets, and emerging market indices are about 30% Korea. And so Korean stocks are going up a lot. I think they're not horribly overvalued like some of the U.S. stocks, but I think they're overvalued. But the one that, to me, and you shouldn't say that one is better than the other three, but 10-year interest rates are saying that the other three might be on steroids, because 10-year interest rates, 56, 57 basis points, they are on their way to zero or even negative, and they've been in a funk. And I said a couple of weeks ago, if they couldn't hold 60 basis points, look out, because there's a big air gap risk all the way to zero. And now we're 56, 57. And so, I have to admit that 3 of the 4 horsemen are positive, so I should probably get more positive, but I just don't see it. I don't see corporations. I'll give you a perfect example. So I live in Chapel Hill, North Carolina. I'm in Tulsa, Oklahoma today for my father-in-law's 84th birthday this weekend. And we went out to get hamburgers last night, and the first restaurant we went to closed. Second restaurant closed. Third restaurant closed. Not closed like we went too late, like closed forever. And that's kind of scary, right? If you think about how many small businesses are really hurting from the lockdown and the repercussions of that. So I don't see it. The economy contracted 32.9% in the second quarter. Everybody says there's going to be some big rebound in Q3. Don't see it. Don't see anybody on airplanes. I mean, I drove from North Carolina here because of concerns about things that I probably don't have as much concern. I would get on an airplane today, but other parts of my family didn't want to, so we drove. And plus, we wanted to bring the dog, but here we are.
One of the other interesting alternative ways to look at things, as we speak today, the S&P is less than 100 points from its high in earlier, let's say, February. But if we price the S&P in gold, what are we seeing?
Look, this is maybe the most important point, and anyone who listens to you and follows you understands this. Look, gold is money, and it has been money for 5,000 years. It's the perfect store of value. An ounce of gold's bought a fine man's suit for 5,000 years. So from Cleopatra's time to American Revolution to today, you can go to Savile Row, put down an ounce of gold and get a fine man's suit. And what's interesting about that is every other currency in the history of mankind has devalued to zero. The joke Jay Leno said a couple years ago was, there was a rumor that the U.S. government was going to come out with a dollar coin. They already have. It's called a nickel. And right from 1776 to 1913, everybody's hyped up on Hamilton, including myself. I got all the songs running in my head. But from Hamilton's time to 1913, a dollar was worth a dollar. It had a couple ups and downs around big wars, but it was basically worth a dollar. Then in 1913, right? John D. Rockefeller's father-in-law and a bunch of other crony capitalists basically said, we're going to take over, and the banking cabal and the big European family are going to own everything, and we're going to make the bankers rich, and we're going to increase income inequality, and the rich are going to get rich and the poor are going to get poor. And that's what they did. They created the Fed, and they've achieved their goal. We have the highest income and wealth inequality in history. The rich are really rich. The bankers got rich. The JP Morgans et al. Got really, really rich. And the dollar has been totally trashed. And so this thing called money illusion is, I ask people all the time, what's the lowest price you remember for a gallon of gas, right? And I remember it specifically. Mine's 31 cents, right? Totem Lake in outside of Seattle, 7-Eleven when I was growing up. And I went to visit my daughter in California before the crisis happened, and I paid $4.31 for a gallon of gas. Now, it's the same gallon of gas, right? It does the same thing, produces the same amount of heat. In fact, it's actually a little less good because it's got a little ethanol in it now. But the gas didn't change in that 48 years. But what changed is the value of the currency buying it. So what's increased, to your point, is the S&P in nominal U.S. dollar terms looks like it's almost back to its high. But if you turned it into real money, into gold, or even more real money, not more real money, but the digital version of that, Bitcoin, if you price the S&P in gold or Bitcoin since the high, it's down materially. And so that is the one thing that makes me think we're not going to have a market crash imminently in nominal terms, is the fact that the value of those assets is declining so rapidly because the dollar is being debauched so stealthily. It's literally like boiling frogs. They don't see the DXY going from 98 to 97.5 to 96 to 94 to 93 to 90, and it's on its way to 80. And you're going to wake up and suddenly that Coca-Cola is going to cost you $5 instead of $4, and your coffee is going to cost you $6 instead of $4, and your purchasing power is being stolen. And people on fixed income and who rely on savings, you're basically having your wealth stolen and given to the owners of the inflating assets like stocks, real estate, and speculative assets like cars and wine and stuff like that.
So as we're talking about the Fed basically destroying the dollar, Mark, can we talk a little bit about what you think is going to be the Great Reset and why a falling dollar is also good for all of our commodities?
Yeah. So look, at the end of the day, there is no other option. As governments become despotic, as I said, and they overspend. I mean, look at this deficit in America. I mean, the Canadian government at least has a little fiscal responsibility, not a lot, but a little. The U.S. government is just crazy. I mean, they literally think you can print money out of thin air and spend it recklessly and just hand people money. Think about it. That's what despots do. That's what dictators do. They buy votes by handing people checks. And that's what we're trying to do in America. And so we're putting multi-trillion-dollar deficits in place. And think about it. If creating wealth was as simple as printing money, wouldn't every country do that? Well, every country has tried it, right? But it's like Zimbabwe and Venezuela. They tried printing lots of currency, and they basically destroyed the value of their currency, or the German Reichmark. So ultimately, we're going to be in this debauchement phase for a long time. And the Great Reset will ultimately happen. Again, it's really hard to predict when, because it literally is like the emperor's new clothes. It literally takes that one little kid to say, wait a minute, he's naked. And that's ugly. But nobody wants to be that kid. Nobody wants to say, well, wait a minute, that doesn't work, because it feels fine. If you're that person who now is getting paid $600 a week, which is more than you were actually making at your restaurant job, you actually would rather stay home and get paid than go back and work at that restaurant probably. But you think about then, if the things that you buy now cost 20, 30, 40% more, you're less well off. So you think you're better off, but you're actually less well off. And it's that stealthy destruction of value that people can't really see. And so ultimately, to answer your question, commodities have underperformed by the most relative to paper in history. So they're at their lowest valuation relative to paper assets in history. And, I have a 9-year-old, so we play rock, paper, scissors a lot when we're bored, although we've been playing a lot more Pokemon lately. And if you think about rock, paper, scissors, paper beats rock. But in the real world, rock beats paper. And rock commodities, I think, is about to go on a 10-year run that is going to just destroy paper. So this is a time to be selling your paper profits and putting it into rocks and other commodities, because I think as the dollar continues to decline and other currencies around the world continue to decline in the race to the bottom, the hard assets, the real assets, are going to appreciate.
So, Mark, another thing that I think we need to consider is when the confidence really starts to falter in the dollar, what kind of risks are we going to see for banks? Obviously, we've heard about Deutsche Bank being in such bad shape year after year after year. And you were mentioning JP Morgan also being somewhat of a risk. Do you think that their gigantic silver reserves at this point would play a role in helping them get through something like a crash?
Look, again, really, really important question. And ultimately, the world today has been financialized to such an extent that the banks truly are too big to fail. And, the big ones, the National Bank of Germany, as I like to call it, there's no chance Deutsche Bank is allowed to fail. Zero. Now, is their equity have any value today? Probably not. Their liabilities probably exceed their assets, but that doesn't matter. And ultimately, one of the trades I've been talking about all year is long Deutsche Bank and short JP Morgan, not necessarily because I think JP Morgan is so horrible. I do think it's wildly overvalued because they have a lot of loans to the oil patch and things like that I think are going to go bad. And I think they're on the wrong side of a lot of derivative trades. But it's not so much that I think JP Morgan's going down as much as 3-4 years ago, Deutsche Bank and JP Morgan had the same market cap. And the Fed bailed out the U.S. banks, basically allowed them to recapitalize their balance sheets by holding interest rates artificially low. Because remember, nobody actually borrows at Fed funds except the banks. So the banks borrow at Fed funds, buy treasuries, arb the spread, and lever it up 11 or 12 times. A riskless trade, 11 times leverage, is a really nice way to make money. So they reliquefied their balance sheets post-global financial crisis. And Deutsche Bank wasn't allowed to do the same because they have a different, model in the European banking. But the bottom line is Deutsche Bank's not going away. JP Morgan's not going away. But today, at the beginning of this year, the ratio between JP Morgan and Deutsche was 25-1. So I just thought there was an interesting play. And if you look at it, I think Deutsche is up 25% and JP Morgan is down 40%. So it's actually been a pretty good pair trade. So ultimately, the banks aren't going away, but I do think, like the zombie banks in Japan, which have been declining for 26 years. Think about that. They've been going down for 26 years. And that's because interest rates have gone down for 26 years and economic growth has gone down for 26 years. It's because of bad demographics, too much debt and deflation. Europe's the same way. European banks have been going down broadly. Lots of them are on the verge of bankruptcy. And I think the U.S. banks, if you look at their long-term charts, are all negative. Look, banking doesn't work at zero interest rates, and it works even less at negative interest rates. And so a new banking system has got to emerge, and that's partly why cryptocurrencies and other forms of monetary aggregates are going to emerge. And so I get pretty excited about the new era of digital finance. But at the root of that, still, you come back to commodities like gold and silver as stores of value that ultimately will be the arbiter of overall value of assets in the world.
So, Mark, as we've seen gold really accelerating towards the upside, what could we see happen if the world went back to a gold standard? Let's talk a little bit about fighting the Fed by having the proper weapon.
Yes, perfect. Look, love that line. In fact, it could be a good hashtag. It's exactly right. You think about it, the Fed has one job, right? And the central bank in Europe and the central bank in Japan, they have one job, right? Which is to enrich the bankers. And the only way to enrich the bankers is to keep interest rates really, really low to keep them in business. Because if they were forced to reconcile their books today, most of them would be insolvent and their equity would be worthless and they'd have to restructure. And people just don't want that to happen. In fact, I remember in 2009, right after the global financial crisis, everything was going up and even the banks were going up. And then there was this hedge fund manager we had money with. And I walked in his office, he literally threw this thing at me. And he said, look at this. I'm like, what are you talking about? He said, Citigroup, they're bankrupt. I said, yep, it's their balance sheet, liability exceed their assets. You're right. The equity is worthless. But it just went from 1 to 5, being short, really bad trade. He said, yeah, I finally figured it out. It's inconvenient for too many people for Citi to go to zero. And that's the fact, right? It's inconvenient for too many people for the equity of certain industries to go to zero. So they're not going to. And so what we've got is this situation where gold is rising, silver is rising. Why? Well, because the currency that we value those in, primarily dollars, are falling. And so it's interesting. I said at the beginning of the year that gold rising and Bitcoin rising this year might not necessarily be that those assets are getting better, but it might just be that the paper assets are getting worse. I call it the fiat fiasco. Is the more fiat you print, like if we start with $1 billion on the table and we print another $1 billion, the value of that paper just went down by 50%. Print another billion or now trillion, and the value goes down. And so to your question about the gold standard, if you look around the world, the smartest governments are actually huge buyers of gold. And if tomorrow we return to a gold standard, which I don't think we're going to, but if we did, gold prices would have to go up about 6 times, almost 7 times where they are today. And if you just let that kind of sink in, you get very excited about owning at least a meaningful portion of your assets in an asset that is basically the perfect hedge against financial Armageddon or against this fiat fiasco. So I'm not saying you should put all your money in it, but I'm saying that you should have a meaningful percentage in gold and silver. You should have a meaningful percentage in digital gold, Bitcoin, which has all the attributes of gold, but a few extras like it's more portable, it's more divisible, it's easier to transact in. It's really hard to carry a big old bar in your pocket and get through customs, but you can put Bitcoin on your cell phone and go anywhere you want. So lots of interesting constructs around this idea that gold as the ultimate money. In fact, I have a hashtag gold is money and everything else is just credit. The famous JP Morgan, which is so funny that JP Morgan had a great line. And, he said, as long as I can control the credit. My other favorite line from JP Morgan is, I like a little competition. So whenever competition got too big, he would basically just put them out of business. But a little competition is good.
So, Mark, can we talk a little bit about, let's say, a more asymmetrical way to play this commodity side of gold and silver and talk a bit more about why silver is undervalued and where we could see the vehicle of SilJ really get to?
Yeah, so a couple things here. One is, the gold-silver ratio. So gold and silver historically have a ratio of value. It's kind of like gold and oil have a similar ratio. And when those ratios get out of whack, you want to own one. You don't necessarily want to be short the other, but you want to overweight one. And the gold-silver ratio has been out of whack really since the beginning of this year, maybe even the end of last year. And it's partly because, silver has more industrial uses than gold. So think about it. Gold and silver are the only things that act both as commodity and currency. And Bitcoin has a little bit of that, but it's just a digital form of gold. And if you think about it, if people think about gold and silver as commodities, they look at things like supply and demand and prices of production and that kind of stuff. And they tend to be a little more volatile, and commodity cycles are more volatile. But when the light switch goes off and people think of them as currencies, that's when they have these asymmetric moves to the upside. And that's what's happening right now. And then what you get is you get people off sides like JP Morgan that gets short too much silver, and they can have real problems. It's just like, if you remember when gold was just around $400 and GLD was just being talked about, and it seems like ancient history, but it wasn't that long ago. And I said, why can't gold go up? Why can't? Well, it's because JP Morgan was, by rumors, short 2 times the number of gold contracts out there. And so there was no way they were going to let gold prices go up because they literally would have been bankrupt. So they had to unwind their derivative books. And then when they needed a counterparty to take the other side of their short trades, they're like, oh, yeah, we like this GLD thing. So it'll be the long side of our short trades. Okay, we'll approve it. And magically, it got approved the next week. So I think the same thing is happening today in that silver has a better upside relative to gold. Not that gold doesn't have good upside, but silver has a better upside because the ratio is off. But the second thing is, like SIL and SILJ, the junior miners, mining has all the tailwinds you could ever ask for, right? The price of their asset that they sell in the market is rising, so that's good. The cost of doing business is falling. Electricity prices are down, oil prices are down, transportation prices are down, trade is down. So all the things that cause them to have lower margins are actually going the other way. So their margins are expanding. And on top of it, they start from low valuations, not as low as they were at the beginning of the year, but they're still really low relative to long-term history. So there is explosive potential upside. It was, but I already missed it. Nah. We've only had 2 other times in history where we've had this kind of collapse in relative value. And the moves up, it sounds funny when you say it out loud, but we're measured in tens, multiples, like 10, 20 times increases. And people say, no, that couldn't happen again. Well, it could. I'm not saying it's going to, but it could. And if you think about investing, what we're paid to do is to take risk. But what we're paid to take is not unintelligent risk, but intelligent risk. Like buying Amazon.com at this price today is an unintelligent risk, if you ask me, because you look at their cash flow generation potential, you look at their current valuation, you say, geez, they'd have to grow really, really fast to grow into that multiple. I don't see how they're going to do it. When you look at a silver miner and you look at the ability to grow into their current valuation, you're like, oh, geez, that's an intelligent risk. Or when you look at Bitcoin or a digital asset, when you think about digital adoption going forward. So asymmetry of risk and return. So you want more asymmetric upside return potential versus your downside risk. The liquidation value of many of the mining companies is significantly higher than their current price or market cap, just the liquidation value. So you get all this asymmetric upside, not for free. There is risk and people can do stupid stuff. And particularly in the junior space, there are some bad actors. So you got to be careful to stay diversified. Because the thing is, you're always going to make a couple mistakes, right? You're going to pick a couple companies and it's going to turn out that, somebody did something wrong or they maybe fudged a little bit of number here or there. So the way you fix that is position sizing and diversification. But generally speaking, mining, one of the best risk rewards on the planet as far as I can find.
Some great insights there, Mark. Do you have any other thoughts as we wrap up?
Look, again, I could talk to you all afternoon and people would get bored. The thing I enjoy about these conversations is we went from the traditional world that everybody's just bombarded with. And I have this line, right? You were drowning in information and thirsting for knowledge. And so it's back to this point of synthesis, is knowing what to ignore, knowing where to focus your time and attention, knowing where there's better opportunity versus lesser opportunity, thinking about, well, this Fangman trade has been great, Facebook, Amazon, Netflix, Google, Microsoft, Apple, and NVIDIA. And, those 7 stocks have been on fire and are valuations that just don't make any sense. And yet the other 493 companies, lots of them are having problems with debt levels and deflation and lack of growth and all the trade rhetoric. And so you look around the world and you say, okay, well, where else can I put my capital? And there are these wonderful other places in these assets that most people don't really spend time thinking about, like commodities and like fixed income. And people listen to the rhetoric of, oh, well, interest rates are so low, they have to go up. Well, no, they actually don't. And in fact, if you do the math, it's more likely they're going to go down than up. And so there's still upside. So thinking about building portfolios with hedges against the really bad outcomes or the really big reset and the asymmetry of those, like long treasuries and gold and silver miners, you don't have to have as much in your portfolio to have a big bang for your buck in the event that the central bank Ponzi finance doesn't work out, which I don't think it will.
Absolutely. We can find more about you on Twitter at Mark Yusko. And anything else you want to highlight?
Yeah, I mean, you can come to our website if you're interested, which is at morgancreekcap.com. I am on Twitter, although it's funny, I've been taking a little Twitter vacation, but I am there a lot. So like my wife would say too much, but I use it kind of as a micro blog, and I love to meet people on there and get feedback on ideas. So do seek me out there. But look, appreciate the conversation as always. Look forward to doing it again. And if anyone has questions, reach out through direct message on Twitter or give you a question and you can get to me and we can get answers for them.
Absolutely. Thanks again for your time, Mark. And I really appreciate having you on again.
Thanks. Enjoy the rest of the summer, what's left of it. And we'll talk again in the fall.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?